This is Bloomberg Wall Street Week.
We may not have an overall recession, we're having a rolling recession. The economy overall looks pretty strong, at least when it comes to jobs.
The financial stories that shape our world.
3 major regional bank failures sent shockwaves through the banking system. We're all trying to figure out what to make of generative AI.
Through the eyes of the most influential voices.
Welcome now, Dr. Paul Krugman, Brian Moynihan of Bank of America, Deborah Lair of the Paulson Institute, Glenn Hubbard of the Columbia Business School.
Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Israel at war with Hamas. The House unable to agree on a speaker. Bank earnings come in mixed, but it all comes against the backdrop of a surprisingly strong U.S. economy. And we ask Fed Chair Jay Powell why.
If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty.
This is Bloomberg Wall Street Week. I'm David Westin. Global Wall Street had plenty to pay attention to this week as the horrific situation in Israel and Gaza continued to play out. With more information about the Hamas attack.
There is no excuse for hitting a hospital full of civilians. All facts need to be established, and those responsible must be held accountable.
And news of an explosion at a hospital in Gaza, which each side blamed the other for.
And based on what I've seen, it appears as though it was done by the other team, not you.
This aggression against our people must stop, and these crimes must come to an end.
President Biden continued to express his staunch support for Israel, making a trip to Jerusalem to meet with Prime Minister Netanyahu, his cabinet, and victims. While the president was in Israel, Republicans in the House of Representatives back in Washington were declining to elect a speaker repeatedly.
Yes, Jim Jordan's out of the race. We're supposed to come back for a candidate forum on Monday at 6:30.
And we got more bank earnings, with Bank of America surprising in a good way.
We've seen our deposit base in the commercial businesses start to grow again after 6 quarters of basically being flat.
Goldman Sachs limping a bit.
Goldman Sachs, where the story still remains subpar profitability.
And Morgan Stanley surprising in not so good a way. But for Global Wall Street, the biggest story was what was going on in the economy and the markets, as retail sales were way better than expected.
Much of that is really because the consumer has, on the whole, not been affected by the increase in interest rates.
On Thursday, Wall Street Week got the opportunity to sit down with the man responsible for monetary policy in the United States, Fed Chair Jay Powell, after his remarks to the Economic Club of New York. And we began by asking him how he accounted for the remarkable resilience of the U.S. economy in the face of all those rate hikes he's imposed.
We certainly have a very resilient economy on our hands. We've got the economy growing strongly. If you think back a year, many forecasts called for the U.S. economy to be in recession this year. Not only has that not happened, growth is now running for this year above its longer run trend. So that's been a surprise, driven largely by consumer spending, driven by a very strong job market with people getting jobs with first high nominal wages, and then as inflation has come down, real wages, which is spurring spending. And we've also had inflation coming down. So, it really is a story of much stronger demand. There may be some ways in which the economy is less affected by interest rates. It's hard to know precisely, but for example, any company with bond market access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough, and again, it's all happening in a context of very strong demand.
Do you see historical precedents for having a growing economy with high rates over a long period of time? I mean, as you look back, is it like the late 90s, for example? What analogies do you draw as you try to determine what this might be doing to the economy over the longer term?
So that's really a question about what the level of rates will be going forward, what the neutral level will be, and I think it's very hard to know confidently what the answer to that will be in 5 years. Some of the reasons why rates were low for the last 25 years were just the aging of the global population and globalization, and so lots of savings and relatively, with an aging population, savings greater than investment, so rates are lower. So all of those led to low interest rates. So what has changed with the pandemic? You might see less effects from globalization. Certainly demographics, the aging of the global population has not changed. This is a discussion we're having on an ongoing basis. It doesn't really affect current policy, but where will rates settle out? What will be a normal rate? So if a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher frequently. Are we going back to that? I really don't know. I wouldn't want to speculate. My guess is it'll be somewhere in the middle, but I don't know. I think we can say this now. The effective lower bound is not an issue. We were very concerned about that. Right now, we're very far from the effective lower bound, and the economy's handling it just fine. But that's because we're at a time of really elevated demand. Coming out of the pandemic, as we reopened with fiscal stimulus and monetary stimulus, we have very strong demand in the United States. Hard to know what the economy will want in the way of interest rates when 5 years from now, when all of the effects of the pandemic are behind us.
You mentioned the long-term equilibrium rate, which you talked about again back in Jackson Hole in August of 2020. Back then you said you thought the sort of consensus had come down. I think it was from like 4.25% to 2.5%. Where is it today?
I think by any reckoning, long-term interest rates and the neutral interest rate came down steadily over the course of several decades. So where is it today? I don't know. We're finding it basically. The idea was, I think the median indication of what the real neutral rate was around 50 basis points before the pandemic. It may have risen in the near term. The real question that matters, though, is will it rise in the long term? And that we don't know.
But do you need to know it in order to conduct monetary policy?
So we all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections. And that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything, we have formulas for everything. Ultimately, as a practitioner, we have to be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now. And we're at 5.25% to 5.5%.
One of the things you're most concerned about is the real economy, what's going on in the real economy. You distinguish yourself from some of your predecessors in that you have a significant exposure to the private sector, not just the public sector, academics. As you talk to CEOs, people in business, what are you hearing about the cost of capital? Because these bond prices are really affecting cost of capital for the first time in a while. There was a long time the cost of capital felt like it was almost zero. And business changes an awful lot when the price of money goes up.
I talked to several people this week who run companies, and they each said that the economy remains strong and that they don't see the consumer. You see there's some areas where spending is softening, but overall, look at the retail sales number. The consumer is strong. Volume's not going up very much, but companies are profitable. You don't, now if you get to where I think the cost of capital would really matter would be for smaller companies and early stage companies, and that really does matter. So we don't have a lot of tools. We have interest rates, and they're far from perfect. It's famously a blunt tool, but it's what we have to get inflation down. And really, the world counts on us to deliver low and stable inflation. That's what we have to do. And at a time like this, we know that we're having negative effects on. We had the home builders in this week. It's a very tough time in the whole home building industry. And we know that, but ultimately, what we want to get back to is a long period of price stability. That's the best thing we can provide, and that policymakers and businesses and everyone and people can just lead their lives not worrying about inflation. This is what we can deliver. It's what we have to deliver, and this is the time. Our independence is not for times when we're really popular. It's for when we're doing something that really the public counts on us to do. Notwithstanding that it's challenging and difficult, and higher interest rates are difficult for everybody.
Coming up, we'll have more with Chair Powell and his views on a post-pandemic economy. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is Wall Street Week. I'm David Westin. When we sat with Fed Chair Jay Powell this week at the Economic Club of New York, we talked about what he has learned about the economy over the last 3 years, about inflation and its connection to labor, and what may be lasting in the effects of the pandemic.
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is to put yourself in the place of legislators and policy, and central bankers around the world. And there was no playbook. We hadn't seen a global economic shutdown. People were thinking that the pandemic might kill a whole lot of people, and that we wouldn't have a vaccine for 5 years, and we might not have an economy for 5 years. So these things were all very possible in March of 2020. And so we pulled out all the stops, and Congress pulled out all the stops. With the benefit of hindsight, could we have done a little bit less and had a little bit of inflation? I guess we could. But I think if you look overall at the performance of the U.S. economy, our economy is the strongest. We're actually also making the most progress on inflation, but we certainly have the strongest growth. We're back to prior growth trend. Not just level of where we were, we're actually back to the prior trend. The labor market, the last time we had this many consecutive months of unemployment below 4% was in the late 1960s, so it's more than 50 years ago. So our economy is doing very well from all of that. But if you had perfect hindsight, you might not have had as much inflation if we'd done less. Although other countries who didn't do as much as we did also had substantial inflation problems.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some, although they still are pretty elevated, if I'm not mistaken. Quits have actually gone up some. It seems to be a tight labor market. What do you make of what's going on in the labor market right now?
Labor market has been extraordinarily strong. So what happened in the pandemic was we had a negative labor supply shock, is one way to think about it. So a whole lot of people left the labor market when the pandemic happened and then didn't come back. And so when the economy reopened and everybody, there was revenge travel and revenge everything, very strong demand, and there just weren't the people. So you had 2 job openings for every person actively seeking employment. We've never been anywhere near close to that. There was panic, and wages and bonuses, and particularly in things like in-person services where people had not gotten big wage increases and didn't want to come back to work. So that's where we were. So since then, there are very many signs that the labor market is getting back into balance, and I talked about some of that in my remarks. Surveys of work, we survey businesses. We don't do it, but other people survey businesses and say, are workers plentiful? And that measure was no, but now it's back to pre-pandemic levels. You survey workers, are jobs plentiful? And that was at an all-time high, and now it's still high, but back. So wage increases are coming back down to more normal levels. Job openings are down from 2 to 1.4. They were at 1.2 in the very tight labor market of 2019. By the work week, by so many measures, the labor market is gradually cooling. And part of that is this, all through 2022, we thought we were going to get more labor supply, and we didn't. And I personally thought, well, I guess we won't get any. And then we've gotten a substantial amount this year. The female labor force participation is in prime age workers is at an all-time high, which has to be related in some way to work from home. But labor force participation increased, immigration increased, and now you see that in the overall cooling of the labor market. So even though job creation is still very high, there are the workers to fill those jobs. And again, businesses will tell you that it's very different. It's still a very tight labor market, but it's loosening.
Coming back to your goal of 2% inflation, what have you learned from this experience about the relationship between inflation and labor? I mean, there's a lot of talk about a Phillips curve, whether it still applies, whether it's weaker, what is it? What's your hypothesis right now with the relationship between inflation and labor market?
Well, let me tell you what it was before. So one of my favorite charts is just the slope of the Phillips curve over 40 years. And so it shows the relationship between unemployment and inflation. If you go back to the high inflation of the 70s, there was a very tight relationship. And that relationship just went down and down and down to the effect where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat. Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened, though, was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it, and workers expect it, and you expect that in your shopping, then that's what'll happen.
That was Fed Chair Jay Powell talking with Wall Street Week at the Economic Club of New York this week. Listening to Fed chairs can sometimes feel a little like going to the Oracle at Delphi. They convey wisdom, but it's not always immediately apparent how to apply it. To help us understand how we should take what we heard from Jay Powell this week, welcome now Dr. Jan Eberly. She's professor of finance at Northwestern's Kellogg School of Management. So, Professor, thank you so much for joining us. Let's talk specifically about what you think we have learned, should have learned about the economy, how we manage the economy from this tumultuous time we've had with the pandemic and the post-pandemic effects.
The chairman yesterday took advantage of the longer format with you to lay out sort of a more holistic view of monetary policy rather than to, make news about the next meeting. And when you asked him about the longer run lessons, he pointed out that the global economy faces a wide range of risks. And COVID really came out of the broader range than we usually see. And importantly, the experience with COVID wasn't really present in the standard historical data that we use to do quantitative analysis or from which policymakers have formed their economic intuition or their heuristics. And so now looking back and seeing how COVID affected the economy and how it's showing up in the data, there were supply shocks, there were reallocation shocks, which just have not been a historical regularity in the data. And so, economists and policymakers are very reluctant to say this time is different. It seems opportunistic, and Reinhardt and Rogoff have a famous book with that title, which was meant with irony. But what the chairman was pointing out is something that economists have been thinking about for quite a while, is what was different about COVID and how does that bear on policy? And in particular, things like the supply shocks and the reallocation shocks allowed a confluence of both tighter monetary policy, rising rates, lowering inflation, and at the same time a robust labor market.
Well, and a couple of other aspects that may be somewhat different from 2019 are, number one, geopolitical risk, which has really popped up, which does have economic effects, obviously, as we increase defense spending, not just in the United States, but around the world. Climate has always been there, but it's getting more and more imminent. There's got a lot of investment that has to be done. And also there are some ramifications of, I won't call it deglobalization, but maybe more regionalization, not quite as globalized as before. Does that indicate that, in fact, the paradigm is shifting toward a higher rate environment?
there's a deep discussion now about what our star is, what the neutral long-run real rate of interest will be. And I think there's been a tendency to think that it's a bit higher, that we're moving away from the sort of secular stagnation concept or model that kept rates very low for a long time, and into a riskier, potentially higher investment environment, which would be consistent with a higher rate of interest.
Professor, thank you so very much for joining us. It was really helpful in interpreting what we have heard. That is Professor Janice Eberly of the Kellogg School at Northwestern. Coming up, we'll take a look at what the markets had to tell us this week with Chris Ailman of CalSTRS. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
The Middle East, once again, is at the center of world events as a horrific attack by Hamas in southern Israel has triggered outrage throughout Israel.
To those who are living in limbo, waiting desperately to learn the fate of a loved one, especially to families of the hostages, you're not alone.
And around the world.
I found the attack on Israel horrifying, as is the prospect for more loss of innocent lives.
We have witnessed a humanitarian nightmare, and thus far the markets have responded with relative calm, waiting to see what comes next.
The big issue in a place like the Middle East today for investors is, does it expand? Will it move into a regional conflict, bringing in nation states like Iran, and then ultimately impacting things like the price of oil that would have an impact on the global economy?
But war always brings with it risks for the economy.
On the economic side, Israel with a reserve army cannot really withstand the long-term mobilization of its forces because much of the economy shuts down. Many stores were closed down. Those stores that are open are seeing their shelves cleared of goods as people stockpile. When it comes to Israel, the effects may be particularly important in the tech sector.
About 18% of our GDP is driven by the high-tech industry. About half of our exports, there is a certain percentage of the workforce which has been enlisted into reserve duty. We estimate that number to be about 15% of the workforce in high-tech. You have to remember, if you're a startup company, and that number can go up to 25% or more.
And given Israel's key role in the international tech ecosystem, those effects could reverberate far beyond the Middle East itself.
It's hard to find any significant venture players who aren't active in terms of backing Israeli companies. Israel has this huge delegation of companies traded in New York. Today, 100 unicorns are operational in Israel. We are already in a capital-constrained environment where companies are cutting their costs, letting people go, trying very, very hard to make sure that they can, get to break even or close, and then make sure they can continue to develop their businesses. Then this comes along, and this is not great in terms of a capital raising environment.
Joining us now is Dan Senor. He is former foreign policy advisor to President George W. Bush and author of The Genius of Israel, a new book that is coming out next month. So Dan, thank you so much for joining us. You know this region terribly well, having served, among other things, as a spokesperson for the coalition in Iraq. We had the horrific explosion of the hospital in Gaza this week. It's a fog of war. Do we know what happened? Will we ever know what happened in that hospital?
Well, Hamas historically, and in this case, in this war, the same will be true. Hamas historically co-locates its offensive weapons capabilities and the offices, the personnel offices of its senior military commanders, its war rooms where decision-making is being made, in hospitals, in UN-run schools, in various child care facilities. Basically, they try to co-locate these, with high areas that have high concentrations of civilians, with the hope that if they fire from there, these people, these innocent civilians around them in hospitals and schools and elsewhere, will effectively be human shields. That is to say that, one, either Israel responds to take out the offensive military capability or the Hamas commanders, and in the process kills a bunch of civilians, innocent, quote-unquote innocent civilians, that then can become a PR win, or B, that Israel then becomes reticent to do it because they don't want to do it. And I think, I dealt with versions of this in Iraq, not this exact situation, but versions of this. I just had to spend a lot of time just trying to educate the press and the public about how these terror organizations work.
But Dan, let me pick up on something you talked about, the PR effect of these things. Again, you've been in these conflict zones. One of the priorities, certainly for the United States government, is to try to limit this conflict so that it doesn't spread to places like Hezbollah up in the north, and goodness knows, not into Iran. What is the danger now, given what we saw happen this week, where the Arab countries apparently pulled back during President Biden's visit? What is the danger that it almost doesn't matter what really happened, the damage has been done?
So there's two issues here. One is, I think the U.S.-Saudi normalization track was moving quickly. And I think it was moving even more quickly than press reports were reflecting. And I think that was possibly, I think there were three motivations for October 7th that we know of. One was Israel's enemies wanted to do something big and dramatic on the 50-year anniversary of the Yom Kippur War. Two, I think that Israel's enemies believed that Israel was particularly vulnerable at this time because of the protest movement in Israel over the last 9 months, and they thought they had seen in Israel unprecedented division and that this was a good time to strike. And then three, that the Saudi normalization process was moving and had a lot of momentum, and they wanted to disrupt it. And one way to disrupt it is to light up the Arab street. How do you light up the Arab street? Create a situation where Israel is in some very messy war with the Palestinians, and that concern for Palestinian life becomes a very highly charged political issue on the Arab street. So I think that is a risk right now in many of the Arab countries.
So Dan, in addition to the Genius of Israel coming out next month, you wrote earlier Startup Nation. Talk to us about what likely effects the conflict we're seeing right now will have on the Startup Nation, if I can call it that, in Israel. That is the tech startups over there that have been such an engine for growth in the Israeli economy.
First of all, if you just the macroeconomics, the Bank of Israel has announced that they think about a 1% of GDP is going to get shaved off so far from this war, and that's less to do about the tech economy, but just tourism shut down. There's no real, the private economy, the non-tech economy in Israel is just not doing much. It's pretty much shut down. When you have 300 to 350,000 reservists being called up, that's an unbelievably high percentage of the overall labor force. So work is just ground to a halt in most parts of the economy. Export a tiny country, as you know, about 9.3 million people, has no real domestic market. So most of the economy is an export focused, and tech is the biggest part of that. My sense so far is most of the tech companies are going to continue to operate. Obviously, they'll have to adjust. It's going to feel a little bit like COVID. Those I speak to in the tech scene in Israel says it's back to remote work, A, because it's not safe to be going into the office, and B, because schools are shut down, so they're back to remote learning, so they have to be home. But the tech companies are still basically working. I've looked at a couple of investments where they're still fundraising. Fundraising hasn't stopped. The big multinational companies, there's between 400 and 450 multinationals that have major innovation centers in Israel. Microsoft, Google, Meta. I mean, you go the major auto companies, even non-tech companies like Walmart, Procter & Gamble, Coca-Cola. All these companies have major R&D operations in Israel, and talking to them, nothing shut down. They're still functioning. Their people are still there. They're going to keep doing what they're doing. I will say, David, but that said, this is an adversarial situation. So things will slow down a little bit, but they're not. My point is, they're not going to grind to a halt. I would say there's one encouraging piece here. In 1991, during the first Gulf War, as you recall, Scud missiles were landing on Israel, and Israel shut down. Everyone was in gas masks, in sealed rooms. No businesses were functioning. Intel, at the time, the Intel Corporation, had a major operation in Israel, and that's where most of their most important R&D for chips was being worked on. And Intel Israel stayed open despite the Scud missiles, and they worked 24 hours a day. They set up volunteer kindergartens so people could bring their kids in, and they had other workers volunteering to take care of kids while others were working in fabs and whatnot. And they never missed a deadline. Everything stayed on schedule, and they sent a message to Silicon Valley, in that particular case to Santa Clara, to Intel headquarters. Don't worry. No matter what they throw at us, we will keep getting it done. And so it's that lesson that we wrote about in our last book, and we read about a little bit in our next book, that was like a reminder that Israelis can be through a lot, or at least their tech community, and still keep chugging along. One encouraging note, and again, it's hard to use the word encouraging in this environment we're in right now is the tech community, the startup nation community, has come together in a way that you would be hard-pressed to find in any other country, and they're a big part of the civilian mobilization and volunteering, and even if they're not called up for reserves, they're helping out in every way possible. And I do think that gives them a kind of a grit and a determination and a whole series of skills in dealing with crisis that I think can only help them, whatever they do after this war, God willing, is over, whether it's their startups or working for big multinationals. So I think near-term bumpy for obvious reasons, but manageable. Medium-term and long-term, I'm actually even more bullish on Israel's startup economy than I was before October 7th.
Dan, thank you so very much for your time. Really appreciate it. It's Dan Senor. He's former foreign policy advisor to President George W. Bush and the author of the forthcoming book, The Genius of Israel. Coming up, looking for leaders who can give us some hope. That's next on Wall Street Week on Bloomberg.
This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
Finally, one more thought. A leader is a dealer in hope. So said Napoleon Bonaparte. And looking around the world today, boy, do we need our leaders to bring us some hope. Hope that we can give workers their fair piece of the pie without destroying the automobile industry in the process.
Today, as the UAW strike against Ford continues, we are at a crossroads. Choosing the right path isn't just about Ford's future and our ability to compete. This is about the future of the American automobile industry.
Hope that the Fed can bring us in for that soft landing with inflation under control and no recession.
Frankly, the Fed has won the battle with the American consumer, and they're slowing down.
Hope that all this money we're borrowing will really be invested in the future of our economy.
The whole point of this is to increase innovation, research, and development in the industry. We're not giving you taxpayer money to fluff your pillow and increase your profit and give it away to your shareholders. We're giving it to you to invest in R&D.
And most especially right now, looking for some glimmer of hope in the Middle East when things look so bleak.
I was outraged and saddened by the enormous loss of life yesterday in the hospital in Gaza. Based on the information we've seen to date, it appears the result of an errant rocket fired by a terrorist group in Gaza.
But at a time when we're looking desperately for hope, it sometimes seems as if some of our important leaders have gone missing. As, for example, we've seen with college presidents who, faced with the admittedly difficult lines to draw between free speech and the moral high ground, have gone strangely silent, at least for a time. At Harvard,
given the number of issues on which leadership at Harvard and other universities have spoken out, to fail to speak out with equal vigor when it is terror towards Israel was, I thought, a real moral failing.
Yeah. And at the University of Pennsylvania.
The university president, Liz McGill, I think she's a good person. I don't think she's anti-Semitic. I do think she made some mistakes here, some of which she's acknowledged. But the decision about her future lies with the Board of Trustees at Penn.
But the biggest absence of all may be in our political leadership, particularly in the House of Representatives, which, faced with the prospect of a continuing war in Ukraine and yet another government shutdown a month from now, decided to do something it had never done before in history, fire its Speaker, the most senior elected member of Congress and third in line for the presidency.
The yeas are 216. The nays are 210. The office of Speaker of the House of the United States House of Representatives is hereby declared vacant.
And this week, after a war begun when Hamas attacked Israel and President Biden asked for emergency funding in an Oval Office address,
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
Republicans repeatedly failed to pull themselves together to name someone to fill the Speaker's all-important job, first rejecting Representative Steve Scalise and then refusing to give it to Representative Jim Jordan.
No person having received a majority of the whole number of votes cast by a surname, a Speaker has not been elected.
We may need our leaders to give us hope at this critical time, but then again, as then Senator Hillary Clinton said about a different war in the Middle East, hope is not a strategy. That does it for this episode of Wall Street Week. I'm David Westin. See you next week.